Picture this. You're at a bustling carnival, surrounded by the dazzling lights of the Ferris wheel, the sweet scent of cotton candy in the air, and the thrill of the unknown. Suddenly, you spot a mysterious tent with a sign that reads, "Fortune Teller, uncover the secrets of wealth." You step inside, and instead of a crystal ball, the fortune teller hands you a company's financial statement. Wait, what? That's right. Those dry, number-filled pages are the real crystal ball when it comes to predicting a company's future. And by the end of this script, you'll be the one wielding the magic, decoding financial statements like a pro investor, spotting red flags, and uncovering hidden gems. Buckle up, because we're about to turn the dull world of balance sheets and income statements into a roller coaster ride of financial wizardry. Let's get one thing straight. Financial statements might look like a snooze fest, but they're the ultimate cheat code for anyone trying to figure out if a company is a golden goose or a ticking time bomb. Think of them as a company's report card, but instead of grades, you get cold, hard cash, or debt staring back at you. And while the average Joe might glaze over at the sight of all those numbers, professional investors know that buried within those pages are the clues to a company's past, present, and, most importantly, future. So, grab your magnifying glass, because we're about to Sherlock Holmes our way through the key components of financial statements and uncover the metrics that make Wall Street's finest sit up and take notice. First up, the income statement, the financial world's version of a company's highlight reel. This bad boy shows you how much money a company made or lost over a specific period, usually a quarter or a year. It's like peeking into a company's wallet, but instead of crumpled receipts and expired coupons, you get three key players: revenue, expenses, and net income. Revenue is the top line, the big kahuna, the show-me-the-money number that tells you how much cash a company raked in from selling its products or services. But hold your horses. Revenue alone is like judging a pizza by its toppings without tasting the crust. Sure, it looks good, but is it really delivering the goods? Enter expenses, the party poopers of the income statement. These are all the costs a company incurs to keep the lights on. Think salaries, rent, and that questionable office party budget. Subtract expenses from revenue, and you get net income, the bottom line. If it's positive, the company's in the black, swimming in profits like Scrooge McDuck in his money bin. If it's negative, well, they're in the red, and you might want to start asking some tough questions. But here's the kicker. Pro investors don't just look at the final score, they dig into the nitty-gritty. A company with sky-high revenue but razor-thin margins? That's like a blockbuster movie with a massive budget but no box office payoff. Red flag alert. One metric that pros love to scrutinize is the gross margin, which is basically the percentage of revenue left after you subtract the cost of goods sold, COGS. Think of it as the company's profit cushion. A high gross margin means the company's got room to breathe, while a low one, they're walking a tightrope, and one misstep could send them tumbling. Another favorite is the operating margin, which takes into account all those pesky operating expenses. If a company's operating margin is shrinking faster than your patience in a DMV line, it might be a sign that management is asleep at the wheel, or worse, spending like a teenager with their first credit card. Now, let's talk about the balance sheet, the financial statement equivalent of a company's Instagram profile. It's a snapshot of what a company owns, assets, what it owes, liabilities, and what's left over for the shareholders, equity, all at a specific point in time. Assets are the shiny toys, cash, inventory, property, and even those fancy patents. Liabilities? They're the financial baggage, like loans, accounts payable, and that awkward IOU from the CEO's cousin. Subtract liabilities from assets, and you get equity, the golden nugget that shareholders care about. But here's the thing. Not all balance sheets are created equal, and pro investors know how to spot the difference between a rock-solid foundation and a house of cards. One of the first things pros look at is the current ratio, which compares a company's current assets, things they can turn into cash within a year, to its current liabilities, bills due within a year. A ratio above 1 means the company can cover its short-term obligations, but if it's too high, they might be hoarding cash like a dragon instead of investing in growth. Another red flag? A debt-to-equity ratio that's climbing faster than a squirrel on an espresso binge. Too much debt is like a ticking time bomb, and if interest rates go up or revenue takes a nosedive, that bomb could go off in spectacular fashion. But wait, there's more. We can't forget the cash flow statement, the unsung hero of financial statements. This little gem tells you how much cash is actually flowing in and out of a company's pockets, broken down into 3 categories: operating, investing, and financing activities. Operating cash flow is the lifeblood of a company, showing you how much cash it's generating from its core business. If a company's reporting profits but has negative operating cash flow, something fishy is going on. Think of it as a magician pulling a rabbit out of a hat. But the rabbit's made of monopoly money. Pro investors also keep an eye on free cash flow, which is the cash left over after the company pays for its operating expenses and capital expenditures. If free cash flow is drying up, it might be time to grab your parachute and bail. Of course, no financial statement analysis would be complete without a healthy dose of skepticism. Pro investors know that companies can get creative with their accounting, and not in a paint-you-a-pretty-picture kind of way. One classic red flag is revenue recognition, when a company books sales before the cash is actually in the bank. It's like counting your chickens before they hatch, and if you're not careful, you might end up with a co-op full of rotten eggs. Another trick? Off-balance sheet liabilities, the financial equivalent of sweeping your mess under the rug and hoping no one notices. If a company's hiding debt in special-purpose entities or other shady vehicles, it's time to run, not walk, to the nearest exit. So, there you have it, the key components of financial statements, decoded in layman's terms, with a side of wit and a dash of professional-grade insight. By now, you should be able to spot the difference between a company that's firing on all cylinders and one that's running on fumes. Remember, financial statements are like a company's diary, and if you know how to read between the lines, you'll uncover the secrets that others miss. Just don't forget to bring your sense of humor, because if you're going to stare at numbers all day, you might as well have a little fun while you're at it.